Everyone knows Visa is a great business. 46.3% return on invested capital, 50.1% net profit margin, a moat score of 8.8 out of 10, earnings coming July 28th, and the stock is up again today. So why am I not buying? Not because the business is broken, it isn't. It might be one of the best businesses ever built, but there is a difference between a great business and a great investment, and most investors never figure that out until they've already paid for the lesson. Today, I'm going to show you exactly what that difference looks like, using Visa as a live case study right now. Let's start with the fundamentals, because Visa's numbers are genuinely extraordinary. The first thing I look at in invyra is ROIC versus WACC. ROIC, return on invested capital, tells you how efficiently a company turns every dollar it deploys into profit. WACC, weighted average cost of capital, is the minimum return a business needs to generate just to justify its own existence. If ROIC is above WACC, the business is creating value. The wider that gap, the better. Visa's ROIC, 46.3%. Visa's WACC, 5.8%. That's a spread of 40.5 percentage points. Most good businesses sit around 15%. Above 20% is considered exceptional. Visa is at 46.3%. Every dollar it reinvests comes back at nearly 8 times the cost of capital. That is not a good business, that is a compounding machine. And the reason it sustains that? It's moat. invyra scores Visa's economic moat at 8.8 out of 10, wide. VisaNet processes transactions connecting 4.9 billion cards, 130 million merchants, and thousands of banks globally. The more participants that join the network, the more valuable it becomes for everyone else. That's a network effect, one of the most durable competitive advantages in business. The financials confirm it. Revenue, $40.00 billion, growing 11.3% year over year. Net income, $20.06 billion. Visa keeps 50.1 cents of every dollar it earns. Free cash flow, $21.58 billion. Financial health, 4 out of 4 checks passed. By every measure of business quality, Visa is elite. So why would I hesitate? Here's the single most important thing I want you to take from this video. The quality of a business determines what you own. The price you pay determines what you earn. Those are two completely different questions, and most investors only ask the first one. Let's look at valuation. invyra's fair value model puts Visa at $312.01. As of today, Visa is trading at $357.75. That's a 14.7% premium to its intrinsic value. What does that mean in practice? It means the market has already priced in years of Visa's future growth. You're not buying Visa at what it's worth today. You're paying for what the market expects it to become. And if that growth comes in even slightly below expectations, you give back that premium fast. Think of it like a rental property. Same house, same $30,000 in annual rent. Pay $600,000, you earn a 5% yield. Pay $900,000, you earn 3.3%. Same asset, completely different outcome. Because the price you paid changed everything. Now, let's look at the technicals. Because the market is sending an unusually clear signal right now. RSI is at 74.4. Anything above 70 is overbought. Visa is sitting deep in that zone. Williams percent R, which measures where the price sits relative to its recent trading range, is flagging a strong sell signal on both the short and long-term time frames. That's not common. Both percent R 14 and percent R 52 are in overbought territory simultaneously. And the stock has run too far, too fast. Momentum, bearish. Timing, bearish. And when I check invyra's Smart Money Index, the signal tracking what insiders and institutions are actually doing, it reads +2. Neutral. No conviction. The people with the most information are not loading up at $357.75. Here's the full picture. 4 green. 5 yellow. Visa is an exceptional business at the wrong price, at the wrong time. Most investors make one of 2 mistakes. They find a great business, buy it at any price, and wonder why the returns disappoint. Or they see the stretched valuation, walk away entirely, and watch the company compound for decades without them. Neither is right. What actually works is a 2-question process, and you can run it on any stock in minutes. Question 1, is this a great business? Check ROIC versus WACC. Is it creating real value or just spinning capital? Check the economic moat. Is there a structural reason competitors can't catch up? Check the financials. Are the margins real? Is the cash flow clean? Does the balance sheet hold up? Visa answers yes to every single one of these. It belongs on any serious investor's watch list. Question 2. Is now the right time to buy? Check the fair value gap. Are you buying at a discount, at fair value, or at a premium? Check the technicals, RSI, Williams %R, momentum. Check smart money. Are the people with real conviction buying or sitting on their hands? Right now, on all 3 counts, Visa says wait. Invyra's IQ score captures exactly this tension. Visa scores 7.1 out of 10, high enough to signal quality, pulled lower by valuation. The platform literally explains why. Business quality carries 55% of the score, but valuation is dragging it down. With earnings on July 28th and the stock up over 2% today alone, the FOMO is real. That's exactly when discipline matters most. What I'm watching for before I'd consider buying. To its price returning toward $312.01. Invyra's fair value. RS, IRA setting below 60 and Williams %R clearing overbought on both timeframes. Smart money index moving off neutral with clear institutional conviction. When those 3 conditions align, Visa stops being just a great business and becomes a great investment. Visa might be one of the best businesses ever built, but the market doesn't pay you for owning great businesses. It pays you for buying them right. That's the distinction most investors spend years and real money learning. If you want to run this exact framework on any stock you're looking at, Invyra gives you all of it in one place. Fair value, ROIC versus WACC, moat score, smart money, technicals. The link is in the description. No credit card required. And if this reframed how you think about evaluating a stock, subscribe. I do this every week. See you in the next one.